Hey everyone, welcome back to Corporate Decoder, where we unpack company documents and give you the real story. The kind that makes you wonder if these filings are actually secret instruction manuals for the financial elite. Today, we're diving into the Putnam Asset Allocation Funds, specifically their Putnam Dynamic Asset Allocation Balance Fund report for September 2025. Stick around because there are some really interesting numbers in here that show just how much things can change, even when the market seems calm. Oh, and before we jump in, if you dig getting the inside scoop on corporate finances, smash that subscribe button. We also have a Discord community linked in the description below where we debate these insights, so join the conversation. Alright, let's get straight to it. This report is about the Putnam Dynamic Asset Allocation Balanced Fund, and it covers the period from October 2024 to September 2025. For the class of shares, we're looking at a return of 11.91%. Now that sounds pretty good on its own, but let's see how that stacks up. The report compares this to the Russell 3000 index, which returned a much higher 17.41%, and a Putnam Balanced Blended benchmark that returned 11.62%. So while the fund did well, it actually lagged behind its main stock market benchmark. What pushed the fund's performance up? Well, it seems like their choices in quantitative large cap core equity and their fundamental and quantitative international equity strategies were winners. On the flip side, they point to security selection decisions within the US large cap growth equity strategy as a detractor. It is like they found some gold, but then tripped over a pebble. Now here is where it gets a bit more complex. The fund used futures to help manage market risk and interest rate risks, and guess what? It had a negative effect on performance over this period. This is a common theme with derivatives, they can be a double-edged sword. Let's talk about what this means for your money. If you had invested $10,000 in class of shares back in September 2015, by September 2025, without considering sales charges or taxes, that investment would be worth about $23,577. That is a solid return over a decade. However, the report also points out that the fund's performance might reflect fee waivers and expense reimbursements. Without those, the performance would have been lower. So keep in mind that the numbers you see are often after some friendly help from the fund company. Looking at the key statistics, this fund is huge. As of the 30th of September 2025, the total net assets were a staggering $2,334,863,119. That is billions of dollars. And the portfolio turnover rate was 158%, meaning they bought and sold a lot of investments within the year. That high turnover can sometimes mean higher costs, even with expense caps. When we look at what the fund actually invested in, it is a pretty diversified mix. Common stocks make up about 74.4% of the total net assets, but then you see significant holdings in corporate bonds at 12.1% and mortgage-backed securities at 9.1%. The largest single sector within common stocks is semiconductors and semiconductor equipment at 7.8%, followed by software at 6.8%. This shows a heavy allocation towards technology and growth-oriented sectors, even within a balanced fund. Now, for some interesting changes that happened during the year, on the 1st of November 2024, Putnam Investments Limited merged into Franklin Templeton Investment Management Limited. Essentially, some investment professionals moved from one Franklin Templeton company to another. This kind of internal restructuring is pretty common in the financial world. Perhaps more significantly, on the 7th of July 2025, the fund started using a wholly owned subsidiary for commodity investments. This means they're going to be dealing with commodity futures and other related derivatives, which can add a whole new layer of risk and potential reward to the fund. This is a strategic shift that could impact future performance, and it is definitely something to keep an eye on. Moving on to other important sections within this document, we see item 2 about the Code of Ethics. The company has adopted a code of ethics that applies to its top executives. This is standard practice. Item 3 discusses their audit committee financial experts. Apparently, Gregory G. McGreevy and Manoj P. Singh are considered financial experts on the audit committee. It is good to know they have people with financial chops overseeing the numbers. Item 4 dives into the fees paid to their principal accountants. For the fiscal year ending the 30th of September 2025, they paid $344,200 for audit services, plus $76,978 for tax compliance and advice. For the previous year, the audit fees were a bit higher at $432,816. These are standard professional service costs for a fund of this size. Now let's pull back to the big financial picture with the consolidated financial highlights for class of shares. The net asset value at the beginning of the year was $17.49, and thankfully, it ended the year at the same $17.49. This might seem odd, but remember, this table shows performance for a share outstanding throughout the year. The important number here is the total return. which was 11.91% for the year, as we saw earlier. For Class C shares, the return was 11.11%, and for Class P, it was 12.30%. These numbers show a slight variation between share classes, which is expected due to different fee structures. Alright, this is where it gets really interesting. The consolidated schedule of investments shows us exactly what this massive fund is holding. On the 30th of September 2025, common stocks made up a whopping 74.4% of their total net assets. Within that, the semiconductors and semiconductor equipment sector alone accounted for 7.8%, and software was at 6.8%. The biggest individual holding by far is Apple Incorporated at $88.5 million. Then you see Microsoft Corporation at $93.3 million. These two tech giants alone make up a substantial portion of the fund's value. The fund also holds significant amounts in corporate bonds, accounting for 12.1% of assets, and mortgage-backed securities at 9.1%. If we look at the total cost of their common stock investments, it was close to $1 billion. And the value as of the 30th of September 2025 was over $1.7 billion, showing a significant unrealized gain on their equity holdings. Their corporate bond portfolio cost them about $285 million, and it was valued at just over $281 million, indicating a slight unrealized loss in that segment. This is pretty typical for bonds, especially with fluctuating interest rates. And their mortgage-backed securities costing around $220 million were valued at over $211 million, also showing an unrealized loss. It is clear they have a significant bet on the tech sector, balanced with bonds and mortgage-backed securities. The fund also has a substantial allocation to senior floating rate interests, with a cost of over $8.8 million and a value of almost $8.7 million. These are essentially loans that adjust with interest rates. Let's look at the agency commercial mortgage-backed securities. The cost was about $12.2 million, with a value of just under $15 million. This part of the portfolio shows a nice gain. Overall, the total investments in securities, after accounting for their cost of $1.75 billion, were valued at a massive $2.48 billion. That is a substantial gain in their investment portfolio. Scroll-based sale commitments proceeds $1748172. Scale, however, there is a negative mark here with TBA sale commitments, showing a loss of over $17.4 million. This likely relates to forward commitments they entered into that didn't pan out as expected. Looking at the consolidated statement of assets and liabilities, the total assets for the fund stand at over $2.5 billion. On the flip side, total liabilities are around $192 million. This leads to a net asset value of $2,334,863,119, which is the figure we've seen consistently. In the statement of operations, the net investment income for the year was about $36.1 million. That is a decent income stream. But the big story here is the net realized gain of over $103 million from investments in unaffiliated issuers. They also had significant net realized gains from swap contracts. When you combine all that, the net increase in the fund's assets from operations for the year was a very impressive $250.8 million. Looking at the transactions in shares, for Class of shares alone, over 5.3 million shares were sold, bringing in about $87.9 million. They also issued nearly 9 million shares from reinvested distributions. And what about the fees? The trustees reviewed the management fee schedules and concluded they were reasonable. They specifically mentioned that the fee schedule for your fund includes breakpoints that can lower fees as assets grow. They also looked at competitive fees and noted that the fund's total expense ratio was generally within competitive ranges, thanks in part to expense limitations and waivers from the advisor. For your fund specifically, the report mentions that its class of share performance was in the top decile of its LIPA peer group for 1, 3, and 5 year periods. That is a really strong showing compared to its peers. Now let's put on our investor hats and look at the big picture. Putnam Dynamic Asset Allocation Balanced Fund is a giant player managing billions. Their heavy tech allocation, particularly in semiconductors and software, has clearly paid off handsomely this year, driving significant realized gains. The fund's strategy seems to be leaning into growth, which has worked well in the current market, but it is important to remember that this also means higher risk. The significant lag behind the broader market, like the Russell 3000 index, and the negative impact from derivatives usage are points worth noting. The fund's approach to managing risk through derivatives is complex, and while it can sometimes offer benefits, it also clearly detracted from performance this year. The fact that they're using a wholly owned subsidiary for commodity investments signals a potential diversification strategy, but also introduces new risks associated with commodity markets. On the fees, it seems the trustees believe they are fair. especially with the expense limitations in place and the strong relative performance compared to peers. Overall, Putnam Dynamic Asset Allocation Balance Fund seems to be navigating the investing landscape effectively, capitalizing on growth areas while attempting to manage risks. The reliance on certain tech sectors and the complexities of their derivative strategies mean investors should be aware of the potential for volatility. The key takeaway here is that while the fund has delivered solid returns, especially for its share classes, understanding the underlying drivers and risks is crucial. So, what is your take on this fund strategy and its performance? Are you comfortable with a heavy tech bet, or do you prefer a more balanced approach? Let me know your thoughts in the comments below. If you found this deep dive into the filings helpful, give this video a thumbs up and make sure you subscribe so you don't miss our next corporate breakdown. Join our Discord community linked in the description to keep the conversation going. Thanks for watching Corporate Decoder, and I'll see you in the next one. Stay sharp out there.